Let's explore problem 6-24. This one is involved with determining the effect of depreciation expense on financial statements. Now, I'm not going to actually solve this one, but I'm going to provide you some hints and some explanations on how you would go about solving this one. Okay, so you can see the problem in front of you, and I'll read it. It's in that first rectangle. And it states, 3 different companies each purchased trucks on January 1st, 2018 for $80,000. Each truck was expected to last 4 years or 250,000 miles. Salvage value was estimated to be $4,000. All 3 trucks were driven 78,000 miles in 2018, 55,000 miles in 2019, 50,000 miles in 2020, and 70,000 miles in 2021. Each of the 3 companies earned $69,000 of cash revenue during each of the 4 years. Company A uses straight-line depreciation, Company B uses double declining balance depreciation, and Company C uses units of production depreciation. And we're going to solve question A1, which says calculate the net income for 2018. Okay, so if you look at this problem, what you understand is that all of the companies are exactly the same except for the depreciation methods they've chosen. All right, so what this means is you need to be able to understand these 3 different depreciation methods, and you need to be able to calculate annual depreciation for 2018. Why do you need to do that? Because depreciation expense is an expense. It gets subtracted from revenues, like all other expenses, to derive net income. And if you jump to the bottom here, what you see is I've indicated that net income is equal to revenues minus expenses. The revenues are given, right? They told you 69,000 in cash revenue, so that's our revenue. Expenses, say, in this problem, the only thing we're given is the depreciation, so we simply have to subtract depreciation from the revenues. Okay? All right. So, let's go over the different depreciation methods so you know what you need to do. All right, straight line annual depreciation means we're going to take the same amount of depreciation in every year. Now, they've made this easy for us in that they purchased the company on the first day of the year, so we don't have to worry about partial year depreciation in year 1. So, you take the cost of the asset you acquired and you subtract the salvage value. Well, they told us the cost we acquire was the cost of the equipment we acquired, and it's the truck, was $80,000. And do they give us salvage value? Yeah, $4,000. So we have to do that calculation. I usually call cost minus salvage value the depreciable base, but I'm not sure anybody else but me calls it that. So take cost minus salvage value, or the depreciable base, and you divide it by the number of years. Okay, I probably should correct that to say number of years. Okay. All right, that's how you handle straight line depreciation. And it's the same depreciation expense every year. So now we can calculate that for Company A. Now Company B uses double declining balance. All right, so what's double declining balance? Well, that's where we take the book value at the beginning of the year and then we multiply it times 2 times the straight line depreciation rate. Well, how do we calculate the straight line depreciation rate? You figure out how many years you expect to use the equipment and you divide that number into 1. So what do they say in this problem? It's expected to last 4 years. So if I were to calculate the straight line rate, I would just simply say, this would be in Excel, equal 1 divided by 4. All right, so my straight line rate is 25, and we simply double that right? So multiply that times 2, and we come up with what the correct percentage to use in our calculation, which is 2 times the straight line depreciation rate. I probably should have bolded that so it looks similar, okay? Now, if we had a piece of equipment that we expected it to last 8 years, the straight line rate would be 1 times 8, or 12.5%, 0.125. So double declining balance, if we expected 8 years, would be 0.25, or 25%. Okay, so that's how we calculate the depreciation each year. That's the rate. Then you have to multiply the book value times the rate. And you always start at the beginning of the year book value, and you calculate it year by year. Now, one thing to remember, this little hint, you can't over depreciate the asset. In other words, cost minus salvage value, or what I'm calling the depreciable base, is the most you can depreciate. So if you run this calculation in the last year, and the end result is that you've depreciated for all years an amount greater than the cost minus salvage value, then you have to stop in the last year once you get to that maximum amount. Okay? But that's how you'd calculate double declining depreciation in each year. Now, in this problem, we're only calculating the first year, so we know that the book value would be equal to the cost of the equipment minus any accumulated depreciation, and there would be none in the first year. Accumulated depreciation builds up after you record depreciation expense from a prior year or prior period. I'm using year and period interchangeably here. Okay, so that takes care of Company B. Well, what about Company C? Well, Company C is using the units of production depreciation method. And I see I have another error. This should probably say units of production typed correctly. Okay? With a hyphen between those. All right, so what do you do here? Well, again, you take the depreciable base, the cost minus the salvage value, and you divide it by the total expected activity. Well, they gave us the cost, they gave us the salvage value, and sure enough, they give us the level of activity. In this case, it's a truck, so the activity that they're using is miles. An easy one for vehicles, since we've got a way to track that right on the dashboard, right? Just simply look at the odometer, and you've got the information you need. Okay, so we're going to calculate a units of production depreciation rate by following that formula. And then each year you simply multiply that depreciation rate. And remember, it's a depreciation rate per activity. So in this example, it's depreciation rate, which will come back as a dollar amount, right? Dollars or cents, or $1.50, $3.50, $5, 21 cents. It comes back in dollars and cents per unit of activity. So ours is per mile. So we're going to depreciate this truck so much per mile. So to calculate the depreciation, you simply take the depreciation rate that we've calculated here and multiply it times the level of activity for that year. How many miles was it driven? And sure enough, they gave us that information right in the problem as well. Okay, so we're able to calculate depreciation under 3 different methods. Then you're simply going to take the revenues minus the expenses to come up with net income for each of these 3 different companies. And from that, you'll be able to calculate net income. Okay, I think that's all you need.